Hello everyone, my name is Oyindolapo Olushesi. Welcome to the beginner class on the components of fintech contracts. I hope that at the end of this short course, you are able to understand some of the basic things that apply in the fintech space. Some of the concepts that have been confusing to you, you are able to understand them and know your way around. Some of these things, right? Hopefully that's the aim at the end of the day. So yeah, in this class we'll be in this short course we'll be covering how fintech lawyers contract, what are the things that they bear in mind when you're doing that, what are important clauses that you need to avert your mind to when you are preparing a fintech contract, what are the types of fintech contracts that we have. Obviously, then we'd also be talking about the different participants in a fintech transaction and the fintech laws and regulators that you will be interfacing with, that you'll be dealing with as a fintech lawyer. So you also need to know them. So we'll just be touching these things at a very high level, so it's not too complicated for you, but just to like introduce you, into the space. That's essentially it, right? So the first things first. I like to share, the things that I share with people generally when we're talking about contract drafting or negotiation. And the first thing is that your contract is your statement to the counterparty, to your client, and to the entire ecosystem. So you want to make a very solid statement. You don't want to be that lawyer who, when people hear, who's the lawyer on the other end? Oh, this guy's going to give me stress. Oh, this guy doesn't know it. This guy doesn't do that. You don't want to be that kind of lawyer. You want to be a lawyer who drafts very as elegant as possible. You want to be the lawyer who understands, the business, understands what the regulator is saying and can apply them. You want to be the guy who your clients can trust as well, right? So you want to make a very good statement as far as statements is concerned. Now, the best commercial lawyers, as far as I know, are good researchers, great communicators, and they are very attentive. That is, they are people who understand the law. They go out and read up, when there are new laws, new regulations, new guidelines, they follow them, they know them, they read them, right? They communicate, they write very well, even if they can't speak, even if they are not the greatest orators out there, but at least when you read their documents, you can understand the process behind them, and then they're very attentive to detail. You don't want to be the guy who is preparing a contract and then the fee is 2 naira capped at 0.2% capped at 2 naira, and then you write 2.5% capped at 10,000 naira. That's obviously going to like affect your client, so you don't want to be that guy, right? Yeah, and another thing is that the law is the beginning and the end, the alpha and omega, the fonte of rigor, right? For your practice. So you don't want to allow your commercial awareness to evade your obeisance to the fonte rigor. You don't want to do that, right? So you need to always understand what the law is saying about what you are doing. Otherwise, you're going to be making a lot of mistakes, right? And the first way to start is with the end in mind, right? So what that means is that you need to know what you are going in for, what your client actually wants out of this. So you are not just blocking your client needs a transaction, but you are the blocker. Doesn't make sense, right? So one very key thing for me again is that verbosity is a crime. Any lawyer that still uses that still drafts in a very verbose manner should be arrested and jailed, right? Obviously, I'm joking, but yeah, I mean, you can draft in very simple, plain time, but still elegant manner. You don't want to be too basic, but you don't also want to be too complex. You want your client to be able to go through your contract and be able to read them, right? So one thing that I always say when we talk about this is in your quest for um, being plain, simple, concise, straight to the point. You don't also want to lose touch with, the concept of what you are doing. So you also want to have that at the back of your mind as well. Now, simplicity, of course, shows mastery. I think that's the summary of everything that we've been saying. Now, your client is king, but that is only as far as the law permits its kingdom. So you don't want to be a part of an insurrection, against the existing government. That's going to be treachery, and you're going to jail, or you're going to be beheaded. I'm kidding, but the point is that you want to ensure that you advise your client according to what the law has permitted. Your client is coming and is saying that, oh, I want to provide interbank, cross-border service, cross-border payments from Nigeria to Iran or from Nigeria to North Korea. Say, oh, no problem, no problem. I'm just going to. You can just start doing that. Just start allowing people to pay money to Nigeria, or Nigerians to send money to Iran, or people to pay money from North Korea. You know, yeah. I mean, I think you get what I'm trying to say. So yeah, you can this scheme, but that is only as far as the law permits the scheme. So, and a very good point to have at the back of your mind is that you are not the master of your fate. Your practicing license is. So you don't want to do something that is going to make you lose your practicing license. This is not just for fintech lawyers. This is for every kind of lawyer. You want to ensure that you are practicing within the ambit of permissible, applicable laws and regulations, right? So again, lastly, and this is very important, negotiation is not war, right? You don't need to show off really. You only need to know what your law is saying, what your client wants, what the law permits, and all of that, and then you stick with it. So you can be, very creative about how you go about it, but you don't need to fight. So let's chill, be homely, and be as respectful as possible. So on that note, we'll be going straight into the first module, which is legal contracting for business people. Business people, because fintech practitioners are usually very business minded, like every other corporate, every other businessman in the corporate world. Really, they're very business minded, so they don't want you to stress them. So the first thing is citing your recital. Now, the recital is a very tiny non-binding part of the contract, depending, and it is contained in the introductory parts of the contract. Now, the aim of the recital is to give a background into why the contract is being made, and sometimes what the parties think they can bring to the table. So your recital is supposed to give a background. Why did these parties decide to sign this agreement in the first place, right? Why did they even decide to sit down and do this, right? So that's the fact. It has to give that background. So I need to be able to read it as a third party that wasn't there when that deal was done, to be able to read it and understand where you guys are coming from, right? So it should be chronological. That's the best thing. You don't want to give a background that is disjointed. Party A died, and then party A was born. It doesn't make sense. So it makes sense for you to make it chronological, right? And it should tell a complete story. So I'm able to understand the full background into what you guys are doing. That doesn't mean you should make it a prose, right? That doesn't mean you should make it a prose. It's just to give me, a third party, an idea into why you guys are contracting, right? So anybody should be able to read that and be able to understand what exactly it is that you are taking from the that you're making, the point you're making in the recital, right? So now for every contract, including a fintech contract, it should give a background into why parties are contracting, right? Now there are key questions I think that you should ask. Who are the parties? In a fintech contract, you are saying, are you a licensed entity? If you are not a licensed, because if you are not a licensed entity and you are telling me that you want to provide you want to provide service that can only be provided by licensed entities, then I have to be very suspect. I need to be very careful. How am I sure that you can do this, right? So yeah, then that is where you now tell me, oh, don't worry, I don't have a license, but I'm leveraging somebody else's license, and then that makes sense to me. So I think your recital should be able to do that, right? What do you intend to do? Oh, I intend to receive payments, or I intend to provide payments. That should also like give that into, so I understand that, oh, okay, this is for a card, even though it's called merchant service agreement, this is for a card, this is for a collection service, right? Or maybe this is for a card creation service. This is for a BIN sponsorship service. BIN is bank identification number, and we don't want to also complicate things. So that's also that's a unique ID that every acquirer has when they are integrating into the card scheme. So yeah, so you can be for that kind of thing, right? So I need to know there is defined. Now the key point is that a recital will be different from, in a fintech contract, will be different from recital in other kind of contracts. So you say, for example, a deed of assignment, the way you deduce your title is not the same way you're going to do it in a fintech contract, obviously. Then the amount of information that you would need to provide would depend largely on the complexity of the contract. So yeah, it's not every recital that you need to have 10 recitals. Could just 2, just 3, even just one, right, will be fine. And the question I'd like to ask here is, does every fintech contract need a recital? What do you guys think? Do you think that you have to provide a reciter for every kind of contract that you're preparing? Short answer would be I don't know. Depends. But it's not every contract that I prepare that I prepare a recital for. Some contracts are just very simple. I'm preparing a two-pager. I don't need a recital for it, right? It's clear. But by the time you read the first page, you already know what it is talking about, right? But for more complex agreements, maybe. But for sometimes as well, some agreements are not simple, but you don't put recital because the agreement speaks for itself, so that's also fine as well, right? So really it depends. I'd like to, I'd like you to think about it. How would you want to go about this? Yeah, we've said that recital gives a background, but do you think every kind of contract needs to have a background? Maybe from your experience, or as you garner more experience, you can think about this. Now, building your contract from the scratch. Now, every corporate lawyer, I think, has had to at some point um, draw up a contract, right? Right. So every corporate lawyer has had to at some point draw up a contract. I think so. I doubt that there's any corporate lawyer that hasn't had to, draw up a corporate a contract at any point in time, even if it's just a contract of what, I don't know, maybe I don't know. I just feel like no matter how basic, you've had to draw up a contract at some point. Now, when you are thinking about drawing up a contract, obviously there are so many things that form your decision to document. Many things make up the terms that you eventually put in your contract. Now, in the fintech world, there are tons of contracts that you deal with every now and then. And I think it's not peculiar to fintech. It's like every other sphere or industry, I presume. And for fintech, it's just basically because there's so many partnerships that you have beyond the simple contracts, right? So when you go to the supermarket and you make a payment, there's been so many people who are involved at the back end in that payment transaction that you just made, and that's one of the things that makes understanding the important elements of fintech contracts make it very, very key. Because if you don't do that, you find out that if you don't understand the basics, if you don't understand who a settlement bank is, or who a switch is, who an acquirer is, you find that when they bring an MSA to you, and the terms there speaks to the terms that a switch or a processor should be having, you are confused. You don't even know where to start. You don't know if your client is supposed to be able to do that kind of thing, or if it is for somebody else, or if there's been a mix-up somewhere and things like that. So you need to be aware, and I think that's the first thing I'm trying to say here. So so how then do you build contracts from the scratch? Now, the first thing to do and to know, to avert your mind to, is that you are probably not a god of creation. And what this means is that you are most likely not going to be thinking of all the clauses that you are working with. You are probably not going to be picking them up from your mind. You're probably not going to say open a blank Google Doc or Microsoft Word document and have to then write out all the terms from the beginning. Maybe some very diligent, smart lawyers have been able to do that for us. So what we have to do now is essentially just add, subtract, do cocktails according to what how regulations change, the business needs of the client, and all of that. But you don't necessarily have to think of everything from your head. That's the first thing. The second thing is that I think, let me use my slide. So the second thing, right, is that, why is my slide not changing? Okay, cool. Now, building a contract depends on one or more of the things that I'm about to say, right? First thing is that, what is the core idea behind the contract? What's the main interest of the company or your client? What exactly are they trying to achieve? So, for example, your client runs a payment platform but has not yet got a license from the CBN, right? So you are thinking, if you're not licensed by the CBN, can you even run a fintech business? Maybe, but yeah, that then forms your consideration with you. So, for example, you don't have a license from the CBN, and then let's say for example you receive the contract from the counterparty, and then they say party B, which is your client, has a license from the CBN. You obviously know that you want to delete that, from the recital or from the capacity clause or something, from the representation clause or something, because that's going to be a misrepresentation of facts. You don't have a license, right? So you also, of course, will not put that kind of thing in your recital when you are preparing the contract, because you don't have, that license. Now, another thing is, if you are, I know a lot of us that will be, watching this video are new to the legal space, but I'm also aware that, I know that, a handful as well would be very experienced in the space, right? So we understand that usually lawyers are brought in after the commercials have been agreed, negotiated, and agreed to, right? So you are not there when the business team is outsourcing or scrambling for the partners in the market. You're not there when they're trying to think about who do we want to have this partnership with and all of that. You are there when the team is thinking, okay, so now we've agreed it's 5 naira per transaction and all of that. So now we need to document these things. Comes in legal, right? So things like payments have been agreed. Chargeback ratio most times have been agreed. So chargeback ratio is just like, what is the how much chargeback can you have per month or per one something transaction. So for example, if you have a ratio 1 to 100, say, okay, you can't have more than one chargeback per 100 transaction, or some people call it chargeback threshold. You can't have more than 0.5% chargeback in a month or things like that. So the team will most likely have negotiated that, and if they haven't, you also want to have that at the back of your mind. And if you're the one in charge in your company, you want to ask that, okay, so obviously this may say, for example, they're telling that you can't have more than 0.01% chargeback in a month. We all know how these things work in the payment space, right? That obviously is not a good deal. So you want to negotiate and say, okay, we're looking 1%, we're looking 2%, and things like that. So yeah, that's that. And another thing is what the regulation says. Does the regulator even care enough to regulate your product or service? So again, there are some products in Nigeria that are not regulated, or that we have regulations, but the regulations are not yet effective. One of them I mentioned earlier is the crypto business. So crypto in Nigeria at the moment is not regulated. The Securities and Exchange Commission has published a regulatory guideline on how to apply for licenses, for virtual asset service providers licenses, but we don't have, it's not operational yet, it's not effective yet. So hopefully with the Startup Act, we're able to get that started, and then we can see how that moves. But at the moment, it is not regulated. So when you are dealing with in an unregulated territory, how do you deal with that? You need to understand that kind of space, right? And I said that the example is that, does the nature of the license held by the counterparty, assuming it is licensed, such that it is able to sub-license? So for example, if you are coming in as someone who wants to leverage, say you want to white label an existing license. White label is just basically that you want to leverage that license. You're saying, what, I want to provide my service, but I don't want people to I don't want to go out there and say, oh, I don't have a license, right? So I just want to say owing payments, maybe then an inscription that is powered by Flutterwave or something like that, right? So yeah, okay, am I able to do that? If Flutterwave is able to provide that kind of service to me, then I want to ask, okay, do I need a regulatory approval for that? So one thing I wanted to ponder on is yeah, so besides regulation, what are the other things that you need to be aware of, right? So you need to be aware of the industry guidelines and standards. So for example, depending on the space where you play, we have the FATF regulations here and there. That's the Financial Action Task Force. You have the PCI DSS, which is from the PCI SSC. You have the NDPA. That's an act. So you have different guidelines and standards that you may need to have your mind to, depending on the kind of space that you work. So for example, you're in the payment space, MasterCard rules, Visa rules, and all of that. You also want to have that at the back of your mind when you are thinking, so this transaction that I'm about to start, which law and regulation applies to it, right? Now you also want to know the terms of your other contracts that you have with other parties, and this is a very crucial thing to bear in mind. If you're providing services that you are down the chain, so for example, you are a payment gateway, right? You haven't plugged directly into, say, into the card scheme as an acquirer, so you are leveraging an existing acquirer, say a bank acquirer, right? Now, that means that you will have an agreement with the bank as your acquirer. Excuse me. That means you have an agreement with the bank as your acquirer. I'm sorry, I think I need to take water. Yeah, so you need to bear in mind the terms of your contract with the bank and your other partners when you are thinking about what exactly it is that you are documenting in your own contract, because you don't want to have, say for example, the bank is giving you a chargeback threshold of 0.5. That means that for whatever it is worth, you can't give your own merchants a chargeback threshold of 0.5. It has to be something lesser. Otherwise, you're going to be falling short of the requirement that the bank is giving you. So what do you then do? You say, okay, in your own MSA, you are going to give your merchant, say, 0.2 or 0.3, depending on how you go about the business. Which is why it's also very key that you ensure that business, when they're negotiating with the other partners, come up with the best deal. Otherwise, you're going to be shortchanging yourself with your, with your other partners. Now, so another thing is the directive of the court. What has the court said about this kind of transaction that you're about to do? So let's take for instance that the CBN went to the bank, sorry, to the court, and said that, court, these guys are dealing in this business, right? Let's say when they took Rice Vest and all those other guys to court, the court then ruled in their favor and said, yeah, you dealing in this kind of business is against the law, right? You have breached a law, that's a criminal offense and all of that. Obviously, you don't want to be the guy who then advises your clients to still go ahead and do that kind of thing, right? It doesn't make sense. So you also want to be aware of that. Now, so another thing you want to be aware of is, what is the other party asking for, right? Does the request favor your clients or does it not favor your clients? You want to know, because if it doesn't favor your clients, you want to know how to deal with that. If it doesn't favor your clients, is it an industry standard? What kind of counterparty are you negotiating with? Is this somebody who will not budge, or can they not budge because they are also tied to another party? Now, this is something that is very, very important. So let me give a very good example here. The industry timeline for settlements for for responding to chargebacks is about 72 hours, right? So which means that the regulator said 72 hours you have to respond to a chargeback. So but you are just the one before the direct client, that's the direct customer, the direct paying customer. So let's say you are the payment gateway. So there is a switch, there's the acquirer, and then there is you, there's the merchant, and there's the customer. So you are just before the merchant. Obviously, you can't expect the bank, your acquirer, to give you 72 hours to respond to chargeback. That's not possible, right? Because if they give you 72 hours, it means that by the time, so if they give you 72 hours, how many hours you want to give your client? Let's say you give your client, your own merchant, say maybe 72 hours as well, right? So what happens? You definitely will be falling short of what the regulator has said, right? So what then happens then is that the 72 hours, the first person at the top will cut out maybe 12 hours. Then by the time it gets to you, say they've given you 24 hours to respond. Obviously, you can only give your client, your merchant, maybe 12 hours for them to respond to whatever chargeback request that you received, that your acquirer itself has also received from the issuer. So that's how these things go. You need to be aware of those things, right? So that you don't just negotiate blindly, right? So yes, you also need to know your deal breaker. What's the deal breaker for your clients? Oh, these guys are asking that we pay interest for if a transaction doesn't pull through, we're unable to settle for a period of time. They're asking that we pay interest. Is this something that we can do? Or we are never going to pay interest on this, right? So it's a deal breaker. It's either they accept that we're not going to pay interest if we're unable to settle, but we're saying that we will pay you back, right? But we won't pay interest on any default. If they accept that, that's fine. Otherwise, we're good to work here from the deal. So you also want to have an idea of what the deal breaker for your client is. Now, I want us to think about this, right? what happens when there is a stalemate, right? So the counterparty is asking for something that doesn't favor your client, and the counterparty is unbending, doesn't intend to shift grounds. What do you do? I'd like to have your thoughts. You can, maybe shoot me an email or send me a message somewhere, or just maybe think about it and document it, and just have maybe a conversation with your friends. I'd like to know what you think about it. What happens? How do you deal with issues when there's a stalemate? The other party is unable to, is unbending, doesn't want to sit down for you. What do you do? Right. Okay, so a quick test. A foreign company is interested in accepting payments from its local customers in Nigeria. It has approached Flutterscope, a leading payments company in Nigeria. Further to which, Flutterscope shared its agreement. You, as the new fintech lawyer in town, has been approached as the lawyer. Now, without opening the agreement, what are the top 5 terms you will be checking out and why? You can just write this down in your notes. Again, you can share them with me. I'll be happy to give you comments as and where possible. All right, so we're moving on to the next, to actually the first module now. And here now we move to the second module. That's module 2, and we'll be discussing some important clauses in fintech contracts. The first thing, and this is so critical to a lot of fintech contracts that you can't miss it, right? Especially when you play in the payment space and you accept card payments. You can't miss it. You can't miss chargebacks. Now, a lot of chargeback refund, they are now used interchangeably, right? But you can't miss the clause on disputes. Essentially, that's what I'm saying. So you definitely will find a clause on disputes, chargeback, refund. Dispute here, of course, is different from legal dispute, as in going to court, arbitration, and all of that. Even though on that chargeback as well, you have the pre-arbitration, you have the arbitration as well. So, but that is not the normal arbitration that we know where we think as lawyer. Dispute here is transaction dispute, and we're saying that you have made payments for something, you've been debited, but the merchants, that is the supermarket where you bought where you bought the thing that you were trying to pay for, didn't receive it, or it returned, payment failed or something like that, right? And you were debited. That's the kind of dispute that we're talking about here, right? Now, a chargeback is a request from an issuing bank to the acquiring bank that an amount was paid to a merchant, an amount which was paid to a merchant be returned to the card holder. Now, why I highlighted those parts, why I underlined them, is because I want to use them to explain the concept to you. Simple as ABC. An issuing bank is the bank that issued the card to you. That's your bank as a customer. That's your bank, right? When you go to the supermarket, the bank whose card you are holding. Now we have OPay, we have all of those are issuing banks as well, right? So the bank whose card you are holding is the issuing bank, right? Now the acquiring bank is the bank that oversees the transaction. I used to call the acquiring bank the powerhouse of the transaction. It's the one that sits in between the different parts of the transaction and ensures that things go smoothly, right? It's like the chairman, right, in a particular transaction. So that's the acquiring bank. In more technical terms, an acquiring bank is the bank that ensures the facilitation of payments, right, between the merchants, the issuer, the scheme, the switch, and all the other participants in a payment chain, right? I don't want to confuse you because it's a beginner class. I just want to take it to a step by step. So just know that the bank, or you can call the acquirer the bank of the merchant. Now, the bank of that is the bank that the merchant has sent on an assignment to receive the payment from you, and I think that makes sense, right? So an acquiring bank is the bank that the merchant has sent to you to come and receive the payment from you. So when you go to say the mall, right, and you're trying to pay for something, the bank of the POS, the bank that the POS that is going to accept the payment from you, that's the acquiring bank. That just let that seem a little. Don't overcomplicate it, right? I think that works for now in the beginner class, right? So that's the acquiring bank. The acquiring bank is the bank of the merchant. Now, because I'm saying the acquiring bank is the bank of the merchant, I also want to distinguish between the bank. The acquiring bank is not the bank that the final money for the merchant is going to. That's a settlement bank. So think about it this way. There are two banks. For the purpose of our illustration, please, there are two banks. The acquiring bank and the settlement bank. Both of them relate to the merchant. That is the supermarket where you've gone to buy what you want to buy, right? Now, obviously, this is an oversimplified example, right? Because they are like different other people. It's not like the merchants. It's not like, say, for example, it's not like Just Right. It's not going to. It's not Just Right that directly relates with the acquiring bank. That's not how it works, really. You know, in more practical terms. But for the sake of our explanation, so we don't overcomplicate things, think about it this way: that is the acquiring bank. There is the settlement bank. The acquiring bank is the bank that Just Right has sent to come and receive payment from you. So Just Right is saying, hey, bank PLC, I run a supermarket business and I want to receive payment from my guys. I say, sure, no problem, I can do that for you. That's the acquiring bank, the bank of the merchant that facilitates the collection of electronic payments on behalf of the merchant. That is the acquiring bank. Now, there's a last bank, which is the settlement bank. So the merchant then says, when you collect this money, take your money and the other fees, deduct them, and please send that money to Bank Limited for me. Right? So that Bank Limited, where the final money is going to, is the settlement bank. I hope that makes sense, right? So one bank is collecting payment from you. The last bank is collecting payment is collecting the final payment. Is the bank where the merchant is going to be storing its money. And I hope that clears up. Don't worry, we're still going to talk about acquiring bank. I think later down the course. So yeah, and you have the merchant, and then you have the card holder. Now notice that I also underlined paid. Now, why did I underline paid? Underline paid because the money has to have been paid. That is, it has to have been deducted from you. Otherwise, no chargeback, right? So, chargeback relates to settled transactions. Sorry, completed transactions, not settled transactions. Cleared transaction. That's a more technical way to put it. Because again, in payments, right? Just to digress a little bit, in payments there is clearing and settlement. When you deal with importation and exportation, you have clearing and forwarding. But here you have clearing and settlement. And what that basically means is that clearing is that the money has been taken from you, and the acquiring bank confirms receipt of it, that, oh yeah, this money is now with me. Settlement is, remember that I said that there's a settlement bank. Settlement is where the settlement bank then receives the money, and everybody can go home and say, yeah, this transaction has been completed. Now, so the reason that that this paid is underlined is that the money has to have been paid. Otherwise, there is no chargeback. What you are going to have is a reversal. Does that make sense? I hope it makes sense, right? So if the money hasn't been paid, what you are going to have is a reversal. So what that means is that, yeah, the money left your account, but it didn't get to the acquiring bank, automatically comes back to you, right? So yeah, now, and then the card holder is you. Now, let's not take the definition of a chargeback again. So a chargeback is a request from an issuing bank, your bank, because again, it makes sense because you are the one that is going to be making the request for the chargeback eventually. You're the one that's going to be saying, Bank PLC or Bank Limited, my money was removed. I went to Just Try to buy biscuits, and I was debited. But guess what? They didn't give me the biscuits because they said they didn't receive the money, right? So you are going to your bank. That's the bank that issued the card to you. Remember, issue card to you, right? Then the issuing bank that says, okay, that's fine. They go to the acquiring bank. That, hey, my guy said that this happened on this date. This is a transaction ID. They paid through card. This is the name on the transaction. This was the fee. This was the time, the location, and all of that. But said that your guy did not give the value for the goods, that is for the payment, that is did not sell the thing to her to him or her because they claimed that you didn't receive payment or something like that, whatever. And then the acquirer, now what happens is that the acquirer then goes to the merchant and say, hey, what's going on? This person said that they paid and you did not give them value for the goods. And so, oh yeah, actually what happened was that at that time the money didn't come through and we couldn't have given it to them, but eventually came through, right? So it's okay. In that case, that's fine. No dispute, no disputation. So you're not contesting it. So you just go back to you just tell the acquirer, okay, that's fine. We are not disputing this. You can deduct the money from us, right? That's fine. Now, but it's not always that simple. Say no, the money didn't come to us, or no, the money actually came to us, but we provided the service to this person. Now we are selling clothes, for example. Let's take maybe Instagram seller, Instagram vendor. Oh yeah, we delivered this thing to this person's house. My delivery man confirmed that it was received, so you can't tell me that you want a chargeback. Then a dispute is lodged, right? So, and then there are procedures as well. So there's a process, pre-arbitration, you have the notice, you lodge your deal to fight, and then if that doesn't work, then you go to the arbitration where the card scheme is involved, and then everything is sorted. But there are timelines within which you have to do all of this, and you need to know this, right? So it's about 120 days from the date that the transaction was carried out to the final date, and you need to stick to these timelines. Yeah. So that's essentially what a chargeback is. So when you read it now, it makes sense to you that it is a request from an issuing bank to the acquiring bank that amount which was paid to a merchant be returned to a card holder. Simple, right? Now, it typically relates to a card transaction, while refund relates to non-card transaction. But these days, you use both of them interchangeably. So you have dispute for you have refund for both cards. You have chargeback for non-card as well, so that's fine. Now, like I said, the reversal is an automatic refund. So reversal is that it didn't come, so just go. Let's just go back to where it is coming from, right? Now, note that while a chargeback and refund, I've already said it, requires you to initiate the process, reversal is automatic, right? So I think we already explained that. I think that's something that we should understand by now. So yeah, and that's that on chargeback, refund, and reversal. This is one clause that you most likely will not miss in your payment transaction, no matter what. You typically will find it inserted somewhere. Yeah, so that's it. Then we have the rolling reserve security deposit. These are a little bit more nuanced, clauses. They are transactions that require them, right? So not every transaction requires a rolling reserve clause or security deposit clause or things like that. So you want to know which transaction relates to it, and we're going to just touch upon them now. Rolling reserve is a device, right, where security is removed on a continuous basis, right? So what that means is that it's removed in small tranches. So basically, sometimes you say we're going to be removing 10% from the settlement date. You remember that settlement is the money that is finally going to the merchant, right? In the merchant settlement bank, right? So so you're saying we'll be taking 10% from this settlement due to you. We'll be taking it for a period of time, right, until we get to X, right? That's a way. Sometimes you say, okay, we're just going to take 10% from this just to ensure that when there's a chargeback, because rolling reserve is usually utilized for chargebacks, right? So that when there's a chargeback against you and maybe you so if it is resolved against you, right, your provider can easily just take from that reserve and then just automatically settle the case, the transaction, right? So 10% until this is done, right? So yeah, that's that on rolling reserve. For security deposits, it's a little bit different. What that one is a lump sum. So for example, while rolling reserve is saying that we're taking 10% of the money, security deposit is saying that, hey, before you onboard on our platform, before you go live, you have to pay, say what, 100,000 down, right? We'll keep it for as long as you transact with us as a security deposit, right? So it's usually for the duration of the contract. Now, When you are reviewing this, you need to involve the business or the dispute team, because they're the ones that typically will set, what the rolling reserve would be, depending on their, interactions with the market and all of that, or what the security deposit would be, right? So yeah, like I said, rolling reserve is common with card transactions. Security deposit is more for high risk transactions. So yeah. Now we move to another very critical part, because when you pay, so one thing that you need to know is that in payment transactions, right? The end goal is the movement of money, right? Either from a customer to the business, or from the business to the customer, from a business to a business, or from a customer to a customer. So the point of initiating the transaction terminates at settlement. Settlement is the final goal, right? Barring, of course, chargebacks that may come in at a later point. But the most important thing is that the money is settled. Now, what that means is that the merchant receives its money. So settlement is the date. Settlement date is the date after transaction when the merchant will receive money. Settlement is the act of receiving money. So, like I said, it could be when the merchant receives the money, or when the customer receives the money. So, when merchant receives money, that is somebody is paying the merchant, that's a paying. When the customer receives the money, that is the money is going out from the merchant's coffers, that is a payout, right? So, but the point is that the final recipient of that money receives the amount that is due to it, right? So there are industry standards for when transactions to be settled. Like I mentioned before, for example, say maybe chargeback should be responded to within 72 hours. There are also, like, for settlement as well, you have T+1 for card transactions. For transactions like maybe bank transfer has to be instant payments. You also have, that's why we also have like NIBS. I don't want to complicate things, but you also have like NIBS products that also help with I'm sure you've heard of NIP before. If you haven't, you can just Google it. It is NIBS instant payments. And for the sake of those who do not know who NIBS is, even though we're still going to touch upon NIBS later, NIBS is the Nigerian Interbank Settlement System. It's a creation of banks and is overseen by the CBN, right? That the NIBS is also a very, very integral part of fintech in Nigeria. Now, for a transaction to be settled, it means that all parties have received what is due to them. That's what the gist of what settlement is. So when you say settlement, it means that everybody has received what is due to them, right? So then you have intellectual property. Now, intellectual property is an integral part of a fintech contract, right? Because many times parties are interacting with each other using a unique technology called the API. Now, I'm sure that if you spend 5 days, max 5 days in a fintech space, either as a new recruit, intern, anything, you must hear API. Oh, we're sharing our API. Oh, we are receiving their API. Think that API, that's application programming interface. And what it is a device, it's a tech that allows two computer systems, communicate with each other, right? So the API is like our MTN or Airtel or whichever one we use, right? That enables us to communicate. So it's like a communication system for technologies, right? For software. Now, in the case of a fintech product, it is what a payment provider would give to its merchant, or a payment provider would give to another payment provider, so that their systems are able to interact for the purpose of providing payment service to you and me, the customers, right? So at the end of the day, what is most important is that you want your people to be able to receive, accept, or make payments, right? So the API usually is what is given. Again, there are products that you don't necessarily need to get an API from, right? But as far as a lot of fintech products are concerned, API is very key. Now, an API is a very important intellectual property, right? So due to the nature, right, you must clearly define the extent of the license that you are granting to the other party. Now, obviously, when you are preparing the contract, the API is not the only IP that you are giving. There's your name, there are details, there are information that you provide. You are providing documentation as well. So there are so many things. There could be know-how that you would also share, maybe business documentation and all of that. You also want to ensure that your agreement is watertight and covers all of those things. Your intellectual property is adequately protected. A short break, but I wish this was all right. So now the next thing that we'll be talking about is the representations and warranties. So here we think about the capacity, KYC information, security certifications and all of that. Now, so a representation is a party saying, as a matter of fact, I have or I am able to do something. That's what the representation is. As a matter of fact, I have or I am able to do something, right? So that's the representation. A warranty is that I assure you that if I don't do this thing, then I will indemnify you, which is that I will make good your position if I don't do this thing that I have told you that I can do or that I am able to do or that I have. Now, so what are the necessary representations that you need to have in your fintech contract? The first thing is that the licensed party, and then you see the way that this has been intentionally crafted to say the licensed party. That is because not every party is licensed, or you don't have to be both licensed parties before you contract. So, but that the licensed party, in actual sense, has that license that it claims to have, right? And that throughout the term of the contract, the license remains valid. And that is because, as you may very well know, licenses are given for a period of time. So 2 years, 3 years, 5 years, and when they are about to expire, they have to be renewed. So you need to ensure that the party who has a license does in fact has a valid license, and the license has not maybe been revoked. Recently the CBN revoked some MLB licenses. Imagine that you're contracting with one of them, and then they show you a license certificate from when the license was still valid, right? So I mean, obviously it was valid then, but now it's no longer valid. So you want to ensure that the license is in fact valid, and that it remains valid throughout the term of the contract. Otherwise, it goes to the core of the contract, and it's going to affect the term of the contract. So that's one thing. You also want to ensure that the necessary parties maintain. Now, another thing that you also want to bear in mind is that the necessary parties maintain compliance with their security standards. So, for example, if you are, contracting to provide card payment services, you obviously need a PCI DSS, right? Certificate. So you need to show that. So you need to ensure that you are compliant with that. You need to, things like the NDPC compliance certificates, when they eventually start giving those out. You want to ensure that all of that is available. Yeah, you have the necessary certification that you need to have, right? Now, so you also want to ensure that there are no regulatory infractions. So for example, you've not been fined. If you've been fined, that's been resolved. You've not been told not to discontinue a particular service. If not, that has also been resolved. That there is no infraction that is going to affect the reputation of the business that you are, that your own client is providing. So those are some of the things you want to have at the back of your mind when you are. Obviously, there are like basic ones like, the company is valid and subsisting, it's gotten the necessary approvals from the shareholders and the board members and all of that, but specifically for, fintech contracts, you want to ensure that the things that affect the core of the business that they provide, like their licenses, certifications, and all of those things are in fact intact, right? So you can also like have things that go through that there are no bugs that they know that would affect the business, that the API doesn't collect more information or give more information than it says it does, and all of that, right? So another clause that you obviously would need to be thinking about is the fees clause. Now the fees clause is where you talk about the transaction fees, right? So what would you charge? How would this be calculated? So you see some things like 0.5% capped at 10 naira, 10.5% capped at 100 naira here. So all those kind of things. When would they be deducted? How would they be given to you? You also need to know that all those things that we're talking about, chargeback, rolling reserve, security deposit, may also then come to play when you are talking about the fees here. Yeah, so then we have the indemnity and limitation of liability. This is a very critical part when you are thinking about fintech contracts, from in the basic sense. So here you are thinking, if something goes wrong, who's going to be responsible for it? Right, that's essentially what an indemnity does. Who's going to be responsible for this thing, right, if it goes wrong? The limitation of liability is saying, okay, no problem, you know what, I'm going to be responsible, but my liability cannot exceed this, or oh yes, you are going to be responsible, your liability cannot be lower than this, right? That's the concept of cap and floor, right? So maximum and minimum liabilities. Now, an indemnity provides comfort for both parties that if you breach this term of this contract, or you breach these rep and warranties, or you fail to carry out your obligation, you are going to make good my position, right? So, in the context of transaction processing, you should be on who is responsible for what. So, for example, the party responsible for processing the payment should be responsible for things that go wrong in the process of processing the payment, right? And obviously, the party who provides its KYC should be responsible for any lies or any inconsistencies in that KYC that affects the other party. So those are some of the things you want to bear in mind, right? The party who provides the tech. So assuming you are only leveraging the tech, you are not providing the tech. There's no symbiotic provision of technology, right? So it's just the API documentation that you are receiving, and then you integrate to your API. In that case, obviously, if anything goes wrong in the tech, the processor or the API owner should be responsible. So those are the things that you want to have in mind. Now, I just sort of like came up with a few considerations for when you are thinking about drafting your indemnity clause. So who does it protect, right? So in some contract you see a one-way indemnity, in some other contract you see a mutual indemnity clause. So who does it protect? In the event of a breach, who is responsible? Now, specific losses that are covered, right? So you again, it depends on where you are from, who you are acting for, right? But so some kind of you want to use some kind of derivative, terms arising out of cost by connection with, so that you don't have a very broad indemnity provision, right? So you want to have something that is specific to this, right? So you want to know to which is this related, to which is this indemnity related, and that makes sense, and it should be treated on a case by case basis. But again, it depends on which side you are on. Obviously, if you are for the client, you want to say, if your position is that, say maybe you are for the client, and all you just need to do is that you just want to access the or let's say maybe you are for the processor, right? You obviously want to push everything down to the merchant side, and you want to say you'll be responsible for everything that goes wrong, apart from if it is from us, right? So, and that's because that some merchants, even though you've KYC them, you do your CDD, that's your customer due diligence. By the way, KYC is know your customer, right? So you've KYC them, you've done your CDD, you've done your enhanced due diligence, all of those things that you need to do, you've done them. Some of them will still not hear what, right? They'll still do things that you've told them not to do. So in those instances, you want to push, what the processor wants to do is to push the responsibilities to them. So as the lawyer for the merchant, you want to be aware of, okay, no, this doesn't make sense, we can't agree to this makes sense, we can agree to this. So yeah, then what triggers the activation of the indemnity? So what triggers the indemnity itself, right? Is it that the indemnity is just go, so at what point, what has to happen for this indemnity to be activated, right? So any specific exclusions or limitations, this is where we now talk about, whether you have like a minimum liability or maximum liability. What you see most is maximum liability. Somebody saying that I can't be liable for more than this. Now, I know the question that runs through the minds of many people is, how do you determine what the maximum liability should be? I've seen some very tough negotiators, right? So you see, they say they won't be liable for more than 1 month fee, right? The standard is usually between 6 months and 12 months. Sometimes you have about 24 months fees that has been earned, right? So, but you see more of 12 months. So the fees end in the last 12 months. In my experience, right, what usually causes the issue is, oh, we want you to mutualize this clause, right? Now there are arguments for and against that. I'll just present them and then just let you decide which one makes sense. So you have the one side of the divide saying that, hey, this thing should be mutual, right? Why is it only your liability that has been capped, right? And the other party is saying, no, we can't mutualize it because we have a higher risk in this transaction than you. Obviously, the provider, the service provider, the transaction processor, the payment processor has a higher risk because they're dealing with more people. You are dealing with just them. They're dealing with more people who also deal with a lot of people. So you imagine how far back they are in the transaction chain, right? And then your customer does something and maybe hacks you, and you fail to notify them, bam, they come in. So they want to ensure that, or again, that's one angle. The other angle is that sometimes they also have agreements with other people that they also need to comply with, and then some of these guys may also be tough. So they want to, like I said, remember when we said that you need to consider the terms of your other agreements before when you're preparing your own contract. So you want to have this at the back of your mind, that what are so you need to know that sometimes these clauses are from those other parts, right? And it may be a deal breaker because there's really nothing they can do about it. So, but usually, yeah, they are thinking from that angle that we have more risk, and we have other parties who we have other partners as well whom we have contracted like this with, right? So the question is, how then do we find a middle ground? So, in my experience again, what has always happened is how important the merchant is, or how important the payment processor is to the merchant. If the payment processor is the only one that can give you the kind of service that you're looking for, man, your hands are tied. You have to go with them. If the merchant is a high volume merchant, then you have to shift ground, in some way for them. So I found that it's usually that. But if you have a better, maybe a better way of solving that, I'd like to hear your thoughts. You can maybe drop me a message or send me a mail or something. But yeah, that's usually how I have seen this happen. Then the next thing is whether the indemnity is in addition to or replaces other remedies. Obviously, is most likely going to be in addition to other remedies, right? That will be available to the injured party. So, notwithstanding anything to the contrary, you will indemnify, or not without prejudice to without prejudice to the other provision or remedy that may be available to party A. Party B will indemnify it if it is mutual. You also prepare it like that. Then data protection. I mean, obviously, you have to have this in your fintech contract because you are dealing with data, sensitive data. There are different classifications for. I just run through it. This is not a data protection class, but there are different classifications for data protection according to different guidelines, standards, and all of that. Obviously, in Nigeria, for example, you need to be aware of the NDPA, that's the Nigerian Data Protection Act, right? But you also have industry specific guidelines like the PCI DSS guidelines by this PCI SSC, that's the Payment Card Industry Security Council, right? You want to know what it says about what is a sensitive data. So for example, under the PCI DSS rules, sensitive data is for cards, right? Sensitive data will be if you store the CVV, that's the code at the back, the expiry date, and the PAN, that's the primary account number. You saw all of them, all the digits like that, one or two of them combination like that, that's a sensitive data. So you need to know then who houses that, who's going to be responsible for that, who is data controller, who's data processor, when are you a joint controller, and all of that. So how can you, when you are appointing a sub processor, what is the procedure for that? Do you have to notify me? Do I have to know if you are going to be having a joint controller over the data that I provide to you? How do we go about that? Do I have to know, and all of that? If you're outside jurisdiction, what happens as well? How do we define the data protection guards around that kind of thing? So you also want to know that as well. So yeah, that's for data protection. Then you have interactions with products. So the last thing that we're going to be discussing is this, right? That you need to understand how your client and the counterparty would interact with the product, right? This is very key. So you want to know, can the service provider suspend without recourse? How can they do this? In what instances can they do this? Again, you need to understand the system. So if your service provider, if you are just a merchant, your acquirer or your processor is also subject to the card scheme, the regulator, and all of that. So yes, if they say they want to suspend in those instances, can you say yes? Or if they say they just want to suspend arbitrarily, can you also say yes? Does that make sense? All of that, you need to think about that, right? So yeah, so like I said, an illustration: can a payment provider be entitled to terminate to immediate termination of the agreement if the merchant fails to maintain its PCI DSS certificate? What do you think? Do you think that if my PCI DSS certificate expires today and I don't renew it tomorrow, should the processor be able to terminate my agreement? Because PCI DSS certificate is something very key, because it gives them comfort that your system is safe. So if you don't have that, is that a ground enough for them to protect their ecosystem by terminating your contract? So yeah, those are some of the things that you need to avert your mind to, obviously. Now, so note that the way you prepare it or draft your contract will depend on whether it's a direct integration or a reseller program. So what that basically means is that are you going straight from the processor to the customers, or you are also like an aggregator of a sense, that is, you have people like you under you, so you are like an aggregator of different merchants. So let's assume you you also provide payment services, but you don't have the license to be able to do that, right? So you go and meet somebody who has a license, who is able to bring you on board, and then you then go through that to your own merchants, right? Who then go to their customers. So that's like a reseller program, right? So you need to understand that, because when you're negotiating a reseller program is different from when you're negotiating if you're an aggregator. The way you negotiate that contract is going to be different from the way you negotiate if you're the direct merchant. So you want to understand that as well. So, and that brings us to the end of module 2. In module 3, we'll be exploring some types of fintech contracts. Now, the types of fintech contracts, there are different types of them. In the chain, you have different people. You have the switch, you have the acquirer, you have the gateway, the settlement bank, issuer, card network, the regulator, NIBs, all of them, right? So you have these people, and then you have you yourself, right? The card holder, So now there are different agreements between these people, and you need to understand where your particular agreement falls in the chain, so that you don't start asking for terms that do not relate to you. You don't start asking for terms that relate to an acquirer in your own contracts. That doesn't make sense, right? So you need to ask for terms. You need to be able to understand where your own contract falls, so that you can ask for the particular terms that relate to you, right? So what we'll do, this is going to be as basic as possible, right? So we'll be exploring the different contracts. Excuse me. We'll be exploring the different contracts and how they are considered. Now we'll be starting with the switch and processing license. In Nigeria, we have the switching and the processing license. Simply, a switch is an intermediary that ensures that all parties receive information they need to make the payment successful. So how I want to send a message to my friend who also uses say maybe I want to send a message to my friend, right? I use an iPhone, my friend uses a Samsung, and I want to send a message to her. I go on WhatsApp and I send the message, right, to that my friend, right? What's happening is that my friend has a WhatsApp on the other end and is able to receive my message. If my friend doesn't have, I send a text message, and then my friend still receives it nonetheless. There is a mobile network in between all of that, or an ISP if it's a WhatsApp, in between all of that allows that to go on. The ISP is your switch, right? That's the guy who ensures that everybody is able to connect, interact, right? It facilitates the clearing and settlement of transaction. Remember that I mentioned clearing and settlement earlier, and I said that clearing is everything that happens before the last guy gets, so everything that happens till your money is deducted from your account and gets to the acquirer. Clearing. The settlement is the final part and ends when the merchant gets its money in, remember, the settlement bank. Right, good. Yeah, so the switch oversees the clearing and settlement of transactions. I just said that. It is usually with an acquirer. Okay, so a switching agreement is usually with an acquirer and not directly with a merchant. So because the switch is up there, it's a senior man in the chain. So it's usually with the acquirer. So understanding what an acquirer does separate from what a switch does is very important, right? Now in Nigeria, every switch is licensed by the CBN, that's the Central Bank of Nigeria, and you have to be registered with the Nigerian Interbank Settlement System. Remember we spoke about them earlier. So the switch is like the central switch, right? Which means that it has like an oversight function over everything that every switch does in Nigeria. So what does this tell you about your responsibilities? Of the responsibility of the switch and the reps and warranties? What do you think? I'd like you to think about it. So this obviously, I mean, as I mentioned, that this should tell you about when you are drafting a switching agreement, and you get to the parts on reps and warranties. It's something that you need to include there, right? Because I said that every switch must be integrated with the central switch. There's something there. Yeah, you find it out. Then there are settlement timelines stipulated by the CBN, which a switch must comply with. What does it also tell you about the settlement clause, right? So these are the places where you get what terms to include, how to prepare your terms, and all of that, right? So then an acquirer agreement. So that's what kind of agreement? The switching agreement that we just mentioned. Just briefly. I don't want to complicate it. I remember what a switch is. I said a switch is like like a mobile network for the payment system. Yeah. I think that works. Yeah. So an acquirer is the overseer in charge of coordinating a payment transaction. It represents the merchant's interest. So remember when we were talking earlier, and we said that the acquirer is the guy who is the merchant's bank, right? So it's the jagaban of the payment transaction. It sits in between and directs everybody to do what they need to do using the switch. So it's like it's the one that it directs the switch on what the switch needs to do. That's the acquirer, right? So for a more technical definition, an acquirer is a bank or financial institution and enables businesses to accept various forms of electronic payments for the goods and services that they sell. That's it. So an acquirer is the guy is a guy that enables financial institution to it's a financial that enables businesses to accept electronic payments that for the goods and services that they provide. That's just basically who an acquiring bank or an acquirer is. So yeah, that's another thing. You also need to know an acquiring bank, an acquirer, they can be used interchangeably, and that's because acquirers are usually bank acquirers, right? So they could be non-bank acquirers, and we're going to mention that eventually. So typically, an acquirer agreement should be with the merchant directly. That's why I said that the merchant's bank, right? So typically, yeah, I mean that's how it should be. But the more practical terms, usually people in the layer. So that's where you have your PSSP and all of that sits in between, right? Because the banks don't integrate directly with the merchants, so they integrate with those guys. Those guys then provide the service to the fintechs, then provide the service to the what now, the merchants, right? Yeah. So acquirers are usually registered with card networks, so they are licensed by the CBN obviously, and they are also registered with the card networks. That's a Mastercard. So whenever you hear card scheme, card network, card association, Mastercard, Visa, Verve, Europay, those are the guys that they're talking about. So yeah, and they are authorized to provide acquiring services. Acquiring service is facilitation of payments, electronic payments. That's what it is, right? Nothing deep. Acquiring is to acquire a transaction is to facilitate the transaction. Ensure that the money is deducted from the issuer, from the card holder, or from the sender, and is received by the receiver. That's all. That's exactly what acquire transactions mean. Acquire card transactions mean. Now, so there are bank acquirers, like I said, and there are non-bank acquirers, these are fintechs. Right now, for this kind of agreements, that's acquire agreements, it's important to consider disputes. That is, remember we talked about this earlier, chargebacks, refunds. You also need to consider settlements, timeline, fees, and all of that when you are thinking about this kind of agreement. You need to know as the merchant, when will I receive my money? How long would I be able to, how long would it take what is the fees that you will charge me? So for example, somebody is paying for a product, is paying 100k. Doesn't mean I'm going to receive all the 100k. Say no. 0.5 capped at 1,000. So if you are paying 100k, we'll deduct 0.5% of that as our transaction fees, and then you receive the rest. That's basically how it is, right? So and then you have the MSAs. That these ones are like the most popular, the merchant service agreements. Merchant service agreements are they're the most common, right? And they affect the bottom. So assuming that the merchant is going to be integrated directly with the acquirer, this is what they will sign with the acquirer. Obviously, the acquirer agreement, is usually signed with, I mean, in more practical terms, is signed with the payment processor. Now, the PSSPs and all of that, the gateways, right? They sign the acquirer agreement. So, which means that the transactions that will be passed, the payments that will be passing through those guys, those processors will be processed in actual sense or acquired by the acquirer, right? That's what it means. That's so now the PSSPs them will now sign a merchant service agreement with you. Simple. Sometimes I've also seen some acquirer agreement that are also titled merchant service agreements, but we know that they are not actually merchant service agreement, and that's because the title of an agreement doesn't really matter. It's the content that matters, which is why your recital has to be very key, right? We said that earlier. So the important thing about an MSA is that it is usually the last agreement just before the main transaction. So it collates all the terms. So for example, the switch and acquirer have agreed that so switch will charge 0.1%. Acquirer card scheme is also going to deduct 0.1%. That's 0.2 already gone. Okay, acquirer is now saying, and acquirer, let's say for example, what else? Let's make it simple. Acquirer is now saying he's going to charge 0.1% as well. That's 0.3%. Then, of course, the processor that is providing the service to you is not also doing it for charity. So it's also going to add another 0.1%. So then you have 0.4%. That's where you now see the differences in different providers. Somebody's giving you 0.5, somebody's giving you 0.7, maybe 0.2, because there are different ways that they mark up the cost, the fees that they are going to charge. So that's it. So that final fee is included in the merchant service agreement, right? So all the other terms, not just the fees, all the other terms like I was also explaining the issue of chargeback earlier. Said that, so for example, the industry is 72 hours. Switch and acquirer, they've given acquirer 48 hours. Acquirer would give your processor 24 hours. The processor will give you as the merchant 12 hours, right? So that's 12 hours for you to respond, because it's still going to be going up and up like that, and the switch doesn't obviously want to fall short of what the regulation has said. Excuse me. So a good lawyer needs to understand this, and you need to know how to work around it. So when you're asking that, so imagine that you as a merchant, you're asking the processor to give you 72 hours to respond to your chargebacks. It obviously shows that you don't understand how this thing actually works. So you need to understand all of that. Now, and that brings us to the end of the conversation on types of fintech contracts. Again, there are still so many other fintech contracts. There is white labeling contracts, there are integration contracts as well, but these are like the basic contracts that help you understand the different journeys, the different parts in the journey for providing a payment. So that's just what this is about, not to complicate things for you, but you understand this, and then you can have an idea of how these things come together. When you see an MSA and you see these terms, you understand where these things are coming from and how to tackle some of these clauses. Hopefully, this has been able to do that for you. Now we'll be looking at, very briefly again, nothing to complicate things for us here. We'll be examining the fintech laws and regulation and the regulators. Right, so we're not going to be delving into the specific, laws and regulation. This law says it. No, we're just going to be looking at them holistically, and you can obviously go on and review the laws yourself. But just so I can also direct your attention to some of these laws, and you can also know some place where you can find them. So the regulators in Nigeria for fintech are very broad. You have specific regulators and you have general regulators. Like the CAC is a general regulator, regulates all the companies in Nigeria. You have the CBN, that's a sector specific regulator for the fintech space. The SEC as well, because there's now a crypto regulation by them, but that's not been effective yet. So they're really very little. But then when you're now into investech and all of that, then you fall under the purview of the SEC. So that's also like a very important part for you to also bear in mind. NICOM, of course, when you're preparing insurtech, that's not exactly fintech, but yeah, included it because everybody just lump all of us together as fintech. Yeah. So, and again, it's a part of fintech, so because it's also a financial technology. Yeah, and that works. But specifically insurtech, you look at NICOM. Then you have the NCC. NCC comes in when you are especially when you are doing providing services like maybe like the mobile money, right? So for you to get a mobile money license in Nigeria, you need the NCC aggregators license, a license from the NCC as well. So you have that, you have NOTAP, you have EFCC. EFCC is mostly for when you are maybe crypto transactions. Crypto at the moment is not exactly um acceptable. So yeah, the EFCC comes in this regard. Yes, and now we'll just be looking at some of them specifically. I mean, what I've said is just like a high level summary of them, and that works for the purpose of for our purposes here, right? So, but we'll just be looking at some of them, specific like the CBN. The CBN works very closely with the NFIU and NIPS, like I mentioned earlier. NFIU is just the Nigerian Financial Intelligence Unit, and the most important thing for you to know here is that there are filings that fintechs need to make every now and then, every month. There are monthly filings, quarterly filings as well that they need to make. So some of these things, for example, like the STR, that's a suspicious transaction report that they file, you have to be integrated into some of these platforms to be able to do that. If you provide a lending platform and then you have, say, maybe like an MFB license, you also want to be able to, access some of the services the CBN that the CBN offers in that regard. Say maybe like the GSI, that's a global standing instruction. You want to be able to just say you can get your money anywhere, right? You also want to be able to integrate into this platform, so you can do maybe BVN verifications and all of that, and make necessary filings as well. So these are like agencies that the CBN works with to be able to provide its services. Now, what I have done is to help with a particular link to where you can get some of the circulars, regulations that the CBN releases every now and then. What I do personally is I just try to check them. It's more infrequent these days, but I still try to do maybe like once a month. So I just do like a check. I just go through the page to just see what new regulations that CBN has released. So yeah, here's a link here. Here is a link for anybody who is interested. Yeah, I'm covered. Okay, so then you have the CSC. CSC is very general, like I said. It regulates the board, shareholders meetings and all of that. And you have SEC. Like I said, SEC released the new rules on the issuance, offering platform and custody of digital assets in 2022. That regulation is not functional yet, however, but if it does, it becomes operational. But then again, if you are playing in the investment tech space, you want to get your fund manager's license or whatever license from the SEC that applies to you. Right, then you have the NDPC. NDPC, of course, was created by the NDP in 2023, and the NDPC, is the data protection regulator in Nigeria at the moment. So you want to, as a fintech company, obviously, data protection has to be top priority for you. So you need to be interfacing with the NDPC as much as possible, right? So the filings, appointments you need to make, your your DPO, you need to have maybe a DPCO, you need to have a DPO, you need to make filings, you need to register as a data controller or a data processor, all of those new things that the Act has now stipulated, you need to be able to do that. Then you have the FCCPC. Recently the FCC was on a roll, just fining and issuing notices and all of that. It's really for people in the lending space, but generally, FCCPC is concerned with consumer protection. So obviously, as a fintech company, you need to ensure that your consumer protection practices are top notch, right? So, and then you have the Startup Act, which created the National Council for Digital Innovation and Entrepreneurship, right? So the Startup Act is yet to be fully implemented, right? That's the word to use. But obviously, that's like another law that's going to apply to fintech startups generally, in addition to other startups, and of course, again, one of the parts one of the sections in the Startup Act even encourages the council to ensure that sorry, even mandates the council to encourage or to work with other regulators to ensure that things that affect startups like licensing and all of those things are easily sorted, so that you don't have all these problems that we currently have a lot in the space. So yeah, that is that on the regulators. Yeah, so in conclusion, the fintech space is really broad. We've been able to talk through just some of the basic things, hopefully just to like give an eye opener into some of these things, bring them together, and then make them make sense to you if they weren't making sense to you before. Now there are so many concepts that are tied together to different products. You need to understand that different products have like different concepts behind them. So you need to know when you're looking at a checkout product, an API product, a bank, maybe there's a bank with transfer. The terms for a bank with transfer will be different from terms for card processing, card acquiring, right? So you need to understand these things. But those are not things that I want us to introduce ourselves to here, because we don't want to confuse you. But if you understand who a switch is, you understand what you look out for in an agreement, when you're reading your CBN regulation, hopefully it's clearer to you now, then you can now start, taking a further step into understanding, okay, card acquiring, pay with transfer, pay with back transfer, what are the terms that you need to have there. And again, what I'm just going to summarize you with is the way you think about these things should be: who are the parties involved, what do they do? Remember the parts on the site. I will say, who are the parties, what do they intend to do? So who are the parties involved, what do they do? In a pay with bank transaction, for example, you don't need a card scheme, right? Because the money is going from your bank account to the merchant's bank account in the same bank, right? So there's no big deal there. There's no stress. If they have to remit, there's no need for card details or anything. Just automatic debit, and so that kind of thing. There's no need for you to be asking for what is the, and it has to be instant, right? So there's no need for what is the, say, what's the word I'm looking for now? What would the card scheme say? How does it affect this card? There's nothing like card scheme on that kind of transaction. I mean, rolling reserve would obviously also not apply to that kind of transaction. But of course, what do you need a rolling reserve for? So you need to understand that, right? So they send you an agreement on pay with bank transfer, and you see a rolling reserve. Obviously, you want to roll your eyes and then ask them, what is this doing there? So the first thing you need to do is sit down and say, who are the parties involved? How will this transaction work? Right? You ask the product person, or you ask whoever it is that has brought this thing to you. Say, how will this thing work? And that is how you then understand. Then you look at your regulation, of course, and then say how you can prepare the contract, or how you would address reviewing the contract, and then you will be good. Hopefully, with the basic concepts that we've covered in this course, you have learned how to get around the fintech space in Nigeria. I really hope so. If you have any questions, you can always send your questions to me on LinkedIn, on Twitter at underscore Oyin at Oyin underscore Lushisi, or LinkedIn at my full name Oyin Lushisi, and I would obviously always respond to you as quickly as I can. So I hope you learned one or two. See you around. Bye.